S&P 500, down a microscopic 0.14% on the closing print, settling at 7,498.96. Dow Jones, essentially flat, shedding 0.01% to 52,218.58.
Right.
And the Nasdaq off just 0.57% to 25,690.90. If you just pull up the scoreboard, you'd think the entire financial world took a long summer weekend.
Yeah, but that surface narrative is a total lie. I mean, you look at the institutional briefing notes from today's session, and desk managers are calling this a choppy mess.
Completely.
A defensive tug of war, because underneath those 0 point whatever index numbers, you had a massive high-stakes rotation going on. Systemic risk limits were literally being stress tested in real time.
Which is exactly our mission for this deep dive. We're unpacking these internal notes to expose the gears grinding beneath that flat tape, because what we actually had today was a violent collision.
Oh, absolutely.
You had escalating geopolitical shocks on one side, slamming right into these jaw-dropping corporate tech capex bills on the other. So let's start with the macro squeeze.
You have to start there.
Right, because you can't understand the equities tape without looking at the commodity shock first. The notes flag serious escalation in the Red Sea, specifically those tanker attacks. And the immediate reaction was just a massive supply-side panic.
WTI crude spikes, what, over 4.28% in a single session?
Pushing past $90.
Yeah, hits 90.59. But the real structural risk here is Brent crude touching the $100 mark. That is not just some psychological level, that's an economic tripwire.
It's the baseline input cost for everything.
Exactly. When oil violently breaks out like that, it instantly bleeds into logistics, manufacturing, everything.
Which immediately revives the market's absolute worst nightmare right now, headline inflation. And the second that inflation fear reignites, the bond market violently reprices.
Right.
Our sources show the benchmark 10-year Treasury yield ripping to a 2026 high of 4.71%. But I want to isolate a critical divergence in the data here.
The safe haven breakdown.
Yes. The classic playbook says, okay, geopolitical panic hits, investors dump stocks, they flood into government bonds, bond prices go up, yields go down. But today, that whole mechanism just fractured.
Completely fractured.
They were dumping equities, but they were also dumping bonds, driving that 10-year yield up to 4.71%. So why could the traditional safe haven trade just outright fail?
Because the traditional trade assumes the Fed has your back. Right. Usually panic hits, you assume the central bank cuts rates to rescue asset prices, you buy bonds to lock in the yield.
Right, the classic Fed put.
Yeah, but with Brent at $100 a barrel, the bond market is staring at a massive supply shock that feeds direct inflation. The Fed cannot cut rates if inflation is roaring back.
Another trap.
Exactly. The market woke up today and realized the Fed put is dead. We are looking at prolonged monetary tightness.
So the algorithmic desks, the systematic funds running massive leverage.
They're doing that exact math. When the cost of capital spikes and your macro tail risk jumps, you don't just rotate. You are forced to aggressively de-risk. You sell stocks, you sell bonds, you just raise cash to lower your gross exposure.
And with that 10-year sitting at 4.71%, acting as this brutal hurdle rate, you get a direct chain reaction in equities. I mean, when money was free, nobody cared about cash burn.
Right, growth at any cost.
But at a near 5% risk-free rate, the gravity on these corporate valuations is immense. Which brings us to today's massive casualty, mega-cap tech.
The AI bill finally came due.
It really did. And the sticker shock was staggering. The notes flag Alphabet dropping about 7.5% today, the catalyst, projecting a monstrous $205 billion in 2026 AI capex.
Plus that European fine.
Right, the 890 million euro regulatory fine. And then Tesla gets hammered even worse, sinking over 13% on compressed operating margins and confirming its own massive spending cycle.
Desk managers are looking at these capex forecasts and just aggressively hitting the bid. I mean, unfathomable amounts of capital being sunk into data centers and specialized processors.
For infrastructure that won't yield consumer profits for years.
Yeah.
But okay, let me push back on the data here, because Alphabet actually beat Q2 headline earnings.
They did.
Google Cloud revenue accelerated sharply. On paper, they're generating cash, building the moat. So why is institutional money violently punishing them for making the exact investments that keep them dominant?
It comes down to the growth capex versus ROI gap. ROI isn't some abstract 2030 concept for these PMs anymore. They want it now.
The narrative shifted.
Exactly. For 3 years, top-line growth was the only metric. Today, sentiment crossed a hard threshold. Top-line growth is totally meaningless if every single dollar of free cash flow is instantly incinerated by AI infrastructure costs.
So even if revenue grows,
If you have to sink $205 billion into servers just to maintain it, there's no cash left for buybacks. There's no cash for dividends.
which circles right back to the 4.71% Treasury yield.
Opportunity cost is the whole game right now. If I'm managing $10 billion, why do I take on the execution risk of Alphabet's $200 billion science project when I can buy a U.S. Treasury and lock in 4.7% today?
The volume confirmation on that selling was brutal. Tech bounced early in the morning, and the institutions just systematically faded that key reversal.
They faded it all day. They dragged it right into the close.
So capital is a closed system. Billions bleed out of tech. It doesn't evaporate. It hunts for a home. And the flight to quality in the briefing notes was incredibly specific.
Energy was obvious.
Right, with crude breaking out. But the real tell was the defensive rotation. Utilities, the most boring sector on the board, completely bucked the market trend and advanced over 2%.
Textbook bond proxies.
Exactly. Highly regulated steady dividends, and most importantly, they aren't engaged in a $200 billion AI arms race. But the single most illuminating print today was RTX Corp.
Massive day.
Total blowout session. Formerly Raytheon, they crushed Q2 earnings, $24.7 billion in sales, up 14% year over year. But the metric that locked in the institutional bids was the backlog.
Unbelievable, Noah.
$289 billion. The market just rewarded them instantly. They held firm all day, totally ignoring the afternoon fade.
Because that $289 billion backlog is the literal financial translation of the Red Sea attacks. It's geopolitical tension converted into guaranteed long-term contractual revenue.
Sovereign rearming.
Yeah, and the real money is buying that revenue visibility.
So if you're a casual observer, you might see flat indexes, utilities, and defense up and think, okay, healthy passing of the baton. Tech cools off, cyclicals catch a bid.
No, absolutely not.
Right, the notes say this is not healthy consolidation.
The internals are screaming structural weakness. If you look beneath the surface, market breadth was terrible. Across the major exchanges, decliners vastly outpaced advancers.
It wasn't just mega cap tech dragging.
No, risk-averse selling swept right through consumer discretionary, communication services, industrials. It was a systemic de-risking.
And the options market confirms the panic.
Yeah.
The VIX spiked aggressively, jumping 14 to 16% to trade up in that 19.0 to 19.4 euro range.
Which is highly irregular for a post-earnings tape. Usually you get earnings from a behemoth like Alphabet, the event risk passes, and you get a volatility crush.
Vol crush, right? The premium drops.
But today, zero vol crush. Options market makers saw a massive, sustained surge for downside protection. PMs are paying huge premiums to hedge because they think this macro tail risk, the oil, the yields, the capex train, is just starting to price in.
Which brings us to the look ahead for tomorrow's open.
Yeah.
Because the technical architecture holding up the S&P 500 into the close is incredibly fragile.
Very precarious.
S&P closes near 7,498. And the notes flag an implied index correlation sitting at roughly 7.54, single digits.
Extreme fragmentation.
Right, translate that correlation for a second. It's like a giant game of tug of war. The center of the rope isn't moving. That's our down 0.14% close. But the teams on either side are thrashing wildly, individual stocks making massive directional moves that just cancel out at the index level.
And that masks the real danger zone. Desk managers are zeroed in on a primary gamma support zone sitting right below today's close, from 7,500 down to 7,480.
So let's isolate the mechanics of this 7,480 level, because the notes treat it like a trapdoor.
It is a trapdoor.
When we talk gamma, we're talking options dealers. Usually they act as the ballast, right? The market drops, they're mathematically forced to buy the underlying stocks. Market rallies, they sell, they dampen volatility.
Right, that's being in positive gamma. But the math violently flips if the SPX drops through that 7,480 threshold. Dealer exposure flips, forcing them into negative gamma.
Meaning the ballast shifts to the wrong side of the boat.
Exactly. In negative gamma, to keep their books neutral, dealers have to sell into weakness and buy into strength. They stop absorbing shocks and start amplifying them.
So if we lose 7,480 tomorrow, dealer selling just accelerates the downward spiral right into the weekend close.
Which is why the trading desks are heavily prepping for a day two play. You get a macro shift, this violent of 4.7% yield ceiling. It doesn't resolve in one session. The notes assign a 60 to 65% probability of a downside continuation for tech.
So the mandate tomorrow is do not blindly buy the morning dip.
The structural damage is too fresh. The notes give two very specific day two setups based on this rotation. First, long RTX Corp.
Playing the momentum on that $289 billion backlog.
Right. DEX will buy opening pullbacks, expecting secondary funds to keep reallocating out of tech and into defense.
And the second setup plays the exact opposite side of that flow, shorting Alphabet on any intraday relief rallies.
Because when a trillion-dollar company drops a $205 billion capex bomb, the liquidation takes days.
Analysts literally have to open their DCF models, punch in the new infrastructure costs, recalculate the price targets, and push those downgrades to clients.
It's mechanical. So the strategy is to assume any Alphabet bounce tomorrow gets met with a wall of sustained selling.
Buying defense pullbacks, shorting tech rallies. That perfectly encapsulates the new reality.
It really does.
Look, if you're managing your risk tomorrow, the core takeaway from this deep dive is simple. Never trust a flat index. That 0.000% close is an illusion masking massive institutional repositioning.
The era of blindly buying the tech dip is paused.
Paused indefinitely. Rising yields and $100 oil created a macro vice today. Investors are demanding immediate cash flow utilities defend over the endless expensive promises of AI.
Right.
Understanding that chain reaction, how a tanker attack in the Red Sea forces a bond algo to sell, which forces a PM to dump Google, that is how you actually read the tape. But I want to leave you with one provocative structural thought as you watch tomorrow's open.
Let's hear it.
We watch big tech get viciously punished today for committing $200 billion to build the AI infrastructure of the future. Wall Street wants that cash flow preserved today. But what happens if the public markets actually force the hyperscalers to stop spending?
That's the real question.
If the friction of a 4.7% yield forces them to prioritize short-term margins, the data centers don't get built, the grids don't get upgraded. If Wall Street defunds the AI revolution because the immediate cost of capital is just too high, who builds the future? Keep your eyes locked on that 7,480 level tomorrow.